Great. Why don't we go ahead and get started? My name's Tim Larson, facilitator with the Transformational Change Learning Partnership, and just want to welcome everyone to today's webinar on sustainable finance. We're thrilled to have everyone here. I know it's probably a hectic week for many, filled with lots of uncertainty, excitement, and angst. But we really appreciate you coming here to really hear about a bright spot in efforts to address the climate crisis. Today we'll be focusing on sustainable finance, and we'll get more into that in a minute. I would like to turn it over to my colleague, Shelby Thomas, to just cover a few logistics things before we get started with today's webinar. Shelby?
Thanks, Tim. Good morning, everyone, or good afternoon, depending on where you are. I'm Shelby. I'm here to help with Zoom logistics and and help the meeting run smoothly. At this point, it's likely that you're all really familiar with Zoom, but quick reminders. We ask that you mute yourself if you're not speaking, just to minimize any background noise. We encourage everyone to use the chat box to share any questions or comments that come up during presentations. When you send those chats, please make sure to send them to everyone in the meeting. If you have a technical question about Zoom, you're welcome to send a chat just directly to me, Shelby Thomas, and I will try to help you troubleshoot that. You are welcome to use the raise hand feature if you'd like to contribute to the conversation. That helps the facilitators know that you have something to share. We also invite everyone to rename yourself in the participants list. At this point, it likely just has your name listed there. You can hover over your name in the participants list and select rename to include your affiliation, which is just nice for anyone who doesn't know you. And I just wanted to give you a heads up that this webinar is being recorded. That includes anything that goes into the chat box. And like I said earlier, if you have any kind of technical questions about Zoom, please feel free to send me a chat in the chat box. I think that's it, Tim. Oh, Tim, you're on mute.
Thank you. You'd think I'd remember that by now. So today our webinar is on sustainable finance, looking at transformation in commercial finance. The objectives, what we're really trying to cover today is highlight some of the recent trends and changes in the global commercial finance sector and how it's attending to climate risks and opportunities, and reflect on the role that the Task Force on Climate-Related Financial Disclosure, or TCFD, and other initiatives over the past few years have had in these finance sector transformations. And then finally, a really key thing for this audience and the work of the Transformational Change Learning Partnership is exploring the potential implications of these commercial finance sector transformations for private sector investments in climate action and sustainable development in the real economy, including in developing countries, and really thinking about what opportunities do these changes in commercial finance really open up for innovative approaches for crowding in investment and attention to advancing and accelerating climate action. In terms of our format for today, I'm going to turn it over in a minute to Joe Dickman from the Climate Investment Fund's Administrative Unit to share a little bit of context about the CIF and its relevance to commercial finance. And then we'll move quite quickly to our two featured speakers today, Professor Ulf Mosliner and Ailun Yang, and I'll introduce them shortly. And then a lot of our time on the call today will be actually open up for questions for our speakers, as well as some facilitated discussion to really explore questions, topics, insights that are relevant to this community focused on transformational change. With that, I'd like to turn it over to Joe. Joe, I'll let you introduce yourself.
Sure, thanks, Tim. Good morning, good afternoon, and evening, everyone. Thanks for joining this. I lead the Evaluation and Learning Initiative here at the Climate Investment Funds, or the CIF, and that includes the Transformational Change Learning Partnership. So thanks for joining. We're excited about engaging in this discussion and on this very critical topic today. For some of you who may be joining who aren't as familiar with the CIF, we are a large multilateral climate fund. We work through multilateral development banks exclusively, who then engage with governments and private sector to provide investments in over 72 developing countries in the areas of clean energy, climate resilience, and sustainable forests. And transformational change has always been at the core of the CIF. It was kind of the founding goal when CIF was designed and launched back in 2008, and it kind of serves as our North Star. CIF seeks to be a catalyst to help leverage broader change and transformation, including helping overcome barriers, create enabling conditions, and help governments, MDBs, the private sector, and others to de-risk early stage investments in a way that can lay the groundwork for scaling broader market impact. A key element of the CIF's model has always been the ability to help foster the conditions that can crowd in private sector or commercial finance to advance climate solutions and sustainable development. And CIF supports this through investments both with public sector and direct private sector investments. So with the public sector and government CIF supported projects are often helping to develop and expand markets that can support climate action in areas such as renewable energy or energy efficiency, sustainable forest management, and climate resilience agriculture, just to give a few examples. And CIF then also has dedicated windows which through MDBs invest directly in private sector entities or with private sector entities. And so given all of this, I think today's topic on commercial finance is really of keen interest to the CIF and our stakeholder community, as well as others who are thinking about broader transformational change. And especially to think about, I think as Tim alluded to, the innovative ways that public and private climate finance can work together to accelerate progress and expand progress. And obviously, being here in the US, we're a bit focused on elections and the role of government this week. But in a way, this webinar and the topic today is kind of a timely reminder that, governments can only do so much. It's really these extremely large volumes of finance and private sector markets that are going to dictate the scale and pace of the transition and the ability to address the climate crisis. And sometimes we find, these communities or sets of stakeholders don't always talk to each other and interact and may not be aware of some of the latest trends or information that one could draw on to help work in these areas and accelerate the investments that we know are needed to accelerate the fight against climate change. So it's a timely topic today and a good reminder of the importance of these wider financial flows and to be on top of what's going on in that space. And we have two excellent speakers today on this topic. They'll be introduced more formally later by Tim, but firstly, Professor Ulf Mosliner, an expert in climate finance. He's been a longtime friend of the CIF, working on the CIF in the CIF's earlier years and now serving on our evaluation and learning advisory group as an external expert. And we're also really excited to welcome Ai-Lun Yang from Bloomberg Philanthropies, who will discuss a little bit more how that philanthropic community is advancing on these issues and how the development finance community may be able to work in more aligned and collaborative ways with them. Next slide, please. And so before I turn it over to Tim, just a quick reminder, this evaluation and learning initiative includes the Transformational Change Learning Partnership, which most of you are a part of and is sponsoring the webinar today. The TCLP is an active community that regularly comes together to discuss and advance thinking and action on concepts and analysis related to transformational change and climate action and how this can accelerate and strengthen innovation and progress in this area. So I'd invite you to visit the website and learn a bit more about TCLP and become involved in our activities if you're not already. So looking forward to the webinar today, and I'll hand it over back to Tim.
Great, thanks, Joe. Shelby, if you go to the next slide. For those of you who have been involved in the TCLP, you'll be quite familiar with some of the transformational change concepts that the TCLP developed a few years ago. Those are currently being updated. Have some webinars we'll mention at the end of the call here to discuss some of those updates, but a lot of the fundamentals still remain the same. And you'll note in the working definition of transformational change, there is a key focus on markets and ways to create those pathways and pipelines for scaling investment in climate action. You'll also notice in the dimensions of transformational change, some things I think we'll hear a bit about today, particularly around systemic changes, is, a lot of the finance and investment can really help with the scale dimension about bringing capital that really enables a lot of climate action to unfold. But getting the systemic changes right, whether it's policy, governance, institutional alignment, market infrastructure and incentives, is really key to creating those opportunities for private sector capital to flow. And so as we go through today's webinar and in the discussion, we'll try and reflect back on how to think about this from a transformational change perspective, and what would it really take to unlock the scale and sustainability of finance that may be needed to drive climate action at the scale needed to address the urgency of the climate crisis. So just wanted to put those framing comments out there. Shelby, if you go to the next slide. Great. So I'd like to introduce, as Joe mentioned, we have two great speakers today. First, we're going to hear from Professor Ulf Mosliner, Professor of Sustainable Energy Finance at the Frankfurt School and Head of Research at the United Nations Environment Program Collaborating Center on Climate and Sustainable Energy Finance. There's a little bit more information on Ulf's bio on the agenda that was sent out yesterday. And then following Ulf's presentation, we'll hear some comments and reflections from Ailun Yang, who's the head of international programs for the climate investment team at Bloomberg Philanthropies. So we're really, and Ailun's fuller bio is also on the agenda. So I encourage you to chat in during the presentations with any questions that you want to make sure that we come back to. Also fine to chat in any comments that you see. We will go through both speakers before coming back and exploring questions and discussion at the end, but feel free to use the chat actively during the conversation. And with that, I'd like to turn it over to Ulf. Welcome.
Yes, Tim, thank you very much. So my name is Ulf Moser, and I'm very delighted to talk to you today and to have a discussion about the things that are going on. So the purpose of this little impulse presentation, if you want, is to talk a little bit about the transformation or the things that are happening in parts of the commercial finance sector, if you want. And so the message that I would like to create basically is that a lot of the questions which are driving daily work in the commercial financial sector are moving closer to the questions that have been driving us in the say climate finance community for quite a while, and that it's interesting to see these topics are moving closer towards each other. I think we can just go to the next slide. Which would be a bit about my background. I'm working for the Frankfurt School UNEP Center, as you already said, where we basically, Frankfurt School, I should say that to explain my background a bit, is a research-driven business school. And within this institute, we're actually also not just doing applied and also some theoretical research, but really engaging in policy advice and projects which are also really coming closer to what actors on the markets would do. Let's just move on to the agenda on the next slide, which is a bit let me start a clock here that I don't get out of control time-wise. So what I want to do is give an impression of, very quickly start with a global background of this. You've been mentioning TCFD already, and then talk a bit more about European level policy action regarding the financial sector, because that's where a lot of dynamics is seen at the moment. And I want to zoom in a bit into, I think, a centerpiece of the European legislation, which is the taxonomy. and then sort of close a bit with talking about what I see financial centers doing, or what individual commercial actors are doing in that field. So I suggest to just move into the slides now. So what really, if you talk to, at least if I talk to the actors on the commercial financial market, what really shook the ground a bit was that speech by then Governor of the Bank of England, Mark Carney, on the tragedy of the horizon, where he basically made a couple of statements regarding the problem that of different time horizons. So essentially, most of the things happening in the financial sector are happening on, or based on, shorter time horizon considerations. So monetary policy, for example, happens at a 2 to 3 year time horizon. Financial stability considerations, max 10 years, typically smaller. Loans typically also have smaller lifetimes than 10 years, but systematically everything related to climate or infrastructure, which is climate relevant, like power plants, have much larger timescales. So that's a bit an issue. And one of his interesting statements was that once climate is actually an issue for financial stability, and he implicitly said that eventually it will be, it's probably too late to react, and that's sort of at heart of this tragedy for the horizon. So based on that, if we go to the next slide, based on that, the financial sector started systematically thinking about this. I actually wanted to add this slide, which is just showing emissions over time, global carbon emissions for the last, I don't know, a couple of 20, 25, 30 years. And it's showing that these trajectories are supposed to go down to practically zero based on the Paris Agreement, go down to zero globally by the second half of this century. That's what's in Paris. And I really, one of the reasons why I put this in is to actually make the point that this, as opposed to what many would say about the Paris Agreement, this thing really personally made my daily life much easier, because it is so much easier to talk about, well, we have to be at zero emission at some point, than talking about these complicated questions like who should emit and abate how much, and that's all this, who is allowed to do how much, who should be doing more than the other. It's far more easy to say that, look, whether we're talking 10 years more or less, at the end of the day, it needs to be zero emissions. And this also nicely shows the ambition. And then it's also, that's an easy, that's also an easy figure here to basically talk to commercial finance people and make that point. Well, look at your portfolio, at your investment portfolio, and then you can ask yourself the question: is this compatible with what most of the heads of government around the world agree, namely getting to zero emissions in the longer run? And if it's not compatible, then, well, there's reason to think about anything, right? And even if you say, oh, that's not going to, we're not going to make this anyway, we can see emissions going up and we can see climate risks rising. So either way, it will be relevant for the commercial actors. And that's what drove a lot of thinking about these things and what these mean for the current business model of many of the financial actors. So if we now go to the next slide, that's probably something that's known to most of you, but it's been based on a global initiative from the Financial Stability Board, which is located at the G20 initiative, so to say, and that's the TCFD, the Task Force on Climate-Related Financial Disclosure, which is, like the name said, thinking about what do these climate-related aspects actually mean for the financial sector. Here, immediately, what they mean for disclosure. Disclosure directly referring to transparency, which is quite an important issue, because asymmetric information is a serious issue for the financial sector, which we have, for example, seen during the financial crisis as well. So I'm not going to go through this in a lot of detail. I think there's two things which I'd like to take out of what they did, out of the recommendations of the TCFD. So I've linked the recommendations or put a link on the slide. I think one thing that's really established by now is to think about climate-related risks in this systematic way. And that would be to divide, to sort of separately think about transition risks, which are risks related to the transition from the current state of the economy towards a low carbon, long-term climate resilient economy. That's basically driven by the measures which have to put the global economy on that path, and distinguish that from the physical risks, which is well, acute risks because of storms, or chronic risks because of rising sea levels and stuff like that. And if actually I've once done that with a student looking, I think it was a bachelor thesis, looking at company reports. And when they talk about climate risks, they pretty much exclusively talk about those physical risks. The transition risks are really not yet very, very present. But when we think about that tough transition change to come, that's probably quite a relevant area, or quite a relevant risk to institutions' portfolios. And of course, there's also talk about the opportunity side and what that brings. A lot of infrastructure needs to be changed, to be financed, and that's business potential for financial actors. So one thing, the risks, transition versus and physical risks, different aspects of a challenge. And the other thing is the recommendation to basically think it from the end, like getting to zero net emissions by the second half of the century, and doing that kind of a scenario analysis. Scenario analysis is an interesting aspect because it sort of means to consistently think that through, which is a bit the reason why I think that's particularly important. Let me chip in that at this point, is that typical risk management or risk measures in the commercial financial sector are basically based on models which are calibrated to data. But if you calibrate your risk models, say value at risk or some or factor models even, right? If you calibrate those those risks models to data from the past, they systematically, by the logic of those models, systematically have trouble anticipating structural change, which is to be expected from the transitional change towards low carbon, right? So that is not really easy to do with those calibrated models. But one way to sort of get around this would be to think in scenario analyses. And that's, if we move on, and that's something that they recommend financial institutions, if we move on, right, that the TCFD recommends financial institutions to perform. We can actually move to the next slide. And this task force on climate-related financial disclosure very, very much motivated or drove the European action. So first, they were starting with groups, market actors and others to basically think about that, talk about consequences. And at the very end, not very end, I'd say rather a start actually, but the EU, the European Commission, came up with an action plan on financing sustainable growth, which is, by the way, soon to be renewed, so to say. And that action plan is interesting in the sense that it's sort of a legislative program for the years to come. And all these different legislative actions, so to say, I've put in the little boxes here with the numbers. And what this picture is trying to show, that actually the whole value chain from the actual companies or projects which are active in doing work which is moving forward the structural change, reducing emissions, could be like a renewable energy project or anything else that is moving things forward. And that whole value chain through the banks, the financial intermediaries, the advisors, or the retail investors at the very end. So that's the whole value, the investment chain, if you want, and the actions thought through by or envisaged by the European Union Action Plan actually address the whole financial investment chain from the individual investor all the way to the actual projects which are moving the transition forward. So that's at least at the financial sector. So this is some kind of systemic thinking about how to move this, basically. And now if you want to talk about all these measures in detail, that's perhaps that's sort of interesting to look at the action plan itself, perhaps just to mention the three spirits in which this the action plan has been written. And the first one is reorienting capital flows in order to make them consistent with that long-term change we agree we need. And then it's a big other point is to make sure that the sustainability issues are integrated into risk management. We talked about the climate and the transition risk issues, and then also fostering transparency and long-term vision, which, if you want to ask my personal opinion, is probably the most, or transparency is one is a straightforward thing. The long-termism is seems to be the largest challenge in that context. And what I'd like to move in a bit, because that's closest to thinking the transition, would be to talk about the EU sustainability taxonomy. If we go to the next slide. Right, so this is a bit of detail on the different actions. And I think so one interesting thing, so first of all, to think about the taxonomy, what it is and why is it a centerpiece. Well, it's thinking about, it's trying to make this bridge, thinking about investment, which of the activities that you could finance would actually be consistent with the transition towards sustainability. And that thinking, what is consistent with being sustainable in the longer run, that actually is, of course, used in many other areas, or at least said to be used. So if we, for example, talk about green bond standards, well, they might be different now, but in the future, it's likely that they will refer to the taxonomy. Disclosures will be using the taxonomy, and benchmarks. At the moment, there's this the provision that you have to talk about your index benchmarks and think about what is sustainable, what part of that. But in the longer run, this will also be related to the taxonomy, essentially, right? And at this point, I should also say, and it probably gets clearer if we move to the next slide, that thinking of the European Commission and of the action plan is actually broader than just talking about climate. This is actually this is referring to sustainability as a whole. So looking at this taxonomy in a bit more detail, that's actually a list of economic activities jointly formulated with performance criteria, and the idea is that they're supposed to contribute to one of many environmental objectives. And frankly, for the moment, only the climate change objectives are really implemented, or like this is where the taxonomy started. There will also be the vision of this is also to include pollution in general terms, healthy ecosystems, circular economy issue, water resource, and all that. But for now, it is really climate change that the Commission started with. And on the next slide, we'll have a bit of a closer look on what that actually means. And that would be basically an activity would be considered to be consistent with the taxonomy if it contributes to at least one of those six environmental objectives. And then it would be in order to sort of try to keep track of the other environmental goals, so to say, at least to be simplified in a simplified way, implemented now through saying it shouldn't do any significant harm to the other 5 environmental objectives, and then some minimum safeguards are implemented. So that's really what this is about. It's actually talking about activities. If we go to the next slide, and that of course is easy for some parts of the economy, but less easy for other parts. The first important thing to note is it's activity-based, meaning that it's not asset-based, but that translation needs to happen basically, but it's activity-based. And then it's easy for things which are not relevant at all for emissions. And it's also easy to say for things that are basically zero emission vehicles, renewable energy, which are evidently consistent with a zero carbon economy. Now, the difficult areas where we see most of the discussions are areas where the activity is basically contributing to a transition, and that would be renovation of buildings. A renovation could be not yet consistent with a zero emission long-term target, but it could be consistent with a path towards that, right? So that's where we will find standards or benchmarks identified. And it's also there's sort of a greening by or an activities which are enabling that transformation criteria, and that is also thought through. So what if you're manufacturing wind turbines? That process will probably generate emissions, but it's not going to be a zero emission activity, right? So that is what is commanding a lot of discussions and attention. And it also is motivated by the fact that the simple idea of just disinvesting from carbon intense industries is maybe a first interesting step, but it's not really going to be creating the transformation in those areas where this is really needed the most. So think about energy intense parts of the industry. That's the critical area where you typically need to identify those actors which are on the right way, so to say, or which are in a good position, let's say that. In a good position to actually be compatible with zero emissions in the longer run. And these actually need investment in order to master that structural change, right? So that is the complicated thing about developing such a taxonomy. Yeah, let's just move on. And that's so the last thing. And on the taxonomy, so what's really then going to be the last step, and it's going to be effective from probably beginning of 22, so not really next year, but from 2022 on, large investments like stock funds will be required in Europe, will be required to report according to that taxonomy. So this fraction of my portfolio is actually consistent with the taxonomy, and that's going to be a broad measure. That's also going to be developed further at the European level. Now, that is basically one example of the European level. There actually have been initiatives across the world in many parts where the commercial actors are meeting. That's organized in the last slide, the Financial Centers for Sustainability. There you can see a lot of, if you go back to the last slide, I promise I'll be fast. So that's where some places where financial centers actually meet in order to drive the transition forward. Now let's go to one example which I know best. Next one, the case of the German cluster. If we go to the next slide, that would be sort of the Green Sustainable Finance Cluster. Germany is just an example of a group where commercial actors in the German landscape, actually including international, I think BlackRock is just about to join, for example. So it's where commercial actors really meet and think about what this transition means for their business model. So actually exchanging on metrics and standards, the things that are bothering in that area anyway, like data and digitalization, and thinking about what that means for their business model and how they can position themselves within that. Let's just move on to the next slide to start. Yeah, so examples which are actually a bit older even than the German example would be the Finance for Tomorrow group in Paris, initiative in London and in Luxembourg. And if we go to the next slide, I've just provided some links. If we go to the next slide, I've just provided some links for those who are interested that show those places where the commercial actors typically meet and think about their strategies. Good. And if we then go to the practically last slide, the next one actually, yeah, let's skip this and let's talk a bit about this because it might be interesting to reflect a bit on what is it that people, what are the challenges of these these groups, actually, because these are institutions which typically like to compete. So that's one of the big questions that they're asking each other. Now, where should we cooperate? And what would be areas where we'd actually like to compete? What is it, where should we be honest and think about our challenges? And where do we want to send strategic signals to the regulator? Same thing goes for the public. So these are challenges which are interesting to observe, but I think it's helpful, and it looks like it's moving actors forward, really. And that brings me now to basically the last comment I made, where this is sort of opening up the view to the international community almost. Again, that's even, and you know, if you would have told me that 5 to 10 years ago, I would never have thought that this is going to happen, that even the central banks, even the Bundesbank, which is not really, has not a big tradition in being sort of engaged in green finance, are active in a network for greening the financial system, which is the central banking network, where you actually talk about the concrete meaning of climate-related aspects, climate-related risks, for what they talk about in their microprudential supervision areas, or when they think about macro-financial aspects, and thinking about institutions, their stability. Actually, we now, even a couple of months ago, we saw the NGFS, the central banking network, publishing climate scenarios to be used by the finance community in order to think about what this might bring to their future, basically. So the central bank network publishing climate scenarios is something that I think is quite interesting, used by the commercial actors, and that's going to bring a lot of discussion in the field. Just today, we had in a meeting of the German Council for Sustainable Finance, a lot of discussions about climate stress testing and how that should look like. And there's a lot of discussion happening there. And if we then go to the last slide, the next one, I mean, it's actually not just a few central banks working here, but it's actually central banks from around the world which are somehow engaged in this field. So that really means there's a lot of stuff happening. Financial actors are increasingly aware of the risks. I mean, we're not yet everywhere there, but we see a lot of promising movements from my personal perspective, which are increasingly shaping the thinking of the whole financial sector in terms of transition, and what that would mean, and how that transition would be moving forward. And I think I should stop it here, because I've already taken a minute too much or so. But thank you very much, and happy to discuss.
Great. Ulf, thank you so much. We're going to turn directly now to Ailun Yang with Bloomberg Philanthropies, and then we'll loop back and address some of the questions that are coming in the chat and open it up for discussion. But I'd like to turn it over to Ailun now.
Thank you. So let me maybe spend one sentence to introduce my organization. I work for Bloomberg Philanthropies. We manage all of Mike Bloomberg's philanthropic activities. The mission of our organization is to help the greatest number of people to have better and longer lives. And for that, of course, environment and is a very important topic. So I work at the environment team. I thank you very much for having me here. I think it was a very comprehensive presentation already by Professor Moslena, but I think maybe I will make a few remarks and comments mainly around these three topics. The first one is around TCFD. I think that's also an issue that we are very involved in, and I would like to share a little bit of update status of where things are. The second is just based on our work, also want to discuss a little bit of how a lot of these climate finance conversation are unfolding in emerging markets, and really what should be the key strategy. And that's, of course, very much our goal there, to really get climate action financed in emerging markets. And the last point, I want to also throw some ideas out about how philanthropy as a form of private sector finance can work work with public finance, and just a few ideas. And I think maybe that one we can discuss more in the discussion session. So on TCFD, I don't think I need to convince this crowd about the importance of disclosure. In Bloomberg, we have a saying that in God we trust, but everybody else need to bring data. It's important that if we want to really start to bring climate risks and consideration into all the business decisions, we need to be able to measure them. And that's why a few years ago, the TCFD task force was set up. Mike Bloomberg was a co-chair together with then Governor McCartney. I want to just say a little bit of where things are. We're very excited to see that TCFD has become really a mainstream framework to talk about climate risks. Today, already more than 1,500 companies signed up for TCFD. However, when we look at the type of reporting that have already been done in the past few years, it's far from ideal. We've seen that in the last 2 years, really the meaningful climate-related disclosure only increased by 6%, and that is in the whole, context of a lot more actions and targets and noises about climate action, but actually the real content only increased by 6%. So you can see the big disconnection here. And I think a lot of it is also about companies who sign up but don't yet know how to do that. So there's still a lot that need to be done in terms of improving the implementation of that. And the second important thing is we've really seen that investors come in and play a quite important role, use their leverage to tell the companies that they are investing in or they might invest in, that they want to see the disclosure. So one famous initiative here, of course, is the Climate Action 100+, and they've made TCFD one of the 3 main demands that they put forward to companies, and that's very encouraging. I think there's a lot more. I think that maybe this platform, we also need to follow how investors are getting together and how their influence is also shaping a lot of the discussion. The third thing, and I want to go back to the scenario analysis that Mr. Moslender just already talked about. TCFD needs a lot more analysis that can really connect climate science to financial discussion, and that's by no means easy. The study that was just mentioned from NGFS, actually that was supported by Bloomberg, and the idea was really try to bring the climate science and modelers community together with financial sector and try to get the conversation going. And it's by no means easy. It was a language barrier-wise, it's still a few blocks away. So still a long way to go to really give TCFD the TC need, which is really an aligned system of language where the climate people and the business people can talk together. And the last thing I want to also share is also the after all, TCFD need to be part of the mandatory system to have to be effective. Of course, TCFD has been very successful so far because it was organized as an industry-led process. It wasn't organized by green activists. It was organized by a group of companies together, and they drive the process itself. And so that's why that I think that we've seen a very rapid speed of sign up to that. However, if we really want to make this the foundation of climate action, then it needs to be mandatory. And of course, we're very excited to see that IFSR actually already start to organize some consultation around TCFD, and that hopefully that's the start of, and of course many countries already have TCFD as part of their mandatory system. Even the EU taxonomy is also very aligned with TCFD. So hopefully we could see a process where this really become part of the international reporting, mandatory reporting system. The second thing I want to say is that, of course, everything that we are talking about here is we really want to see at the end of the day, especially emerging markets, developing country would really embrace development with climate actions. And even though that we see a lot more demands or the net zero commitments from companies, and that really consolidate the type of change of the conversation. However, we don't really see the same thing right now happening in developing country, and for us yet. Not to the level that we would like to see. And of course, COVID-19, the pandemic, will be a very serious blow to their efforts in this area. And I want to just maybe say two things, at least what we've observed as a very important strategy. It's absolutely critical to make sure that we have local political champion for these initiative, and that would actually be the place where large scale of climate finance can come in. We've seen too many of such initiatives led by different players outside, and we haven't, but to get local political champion, it's not easy. It actually requires a lot of underground political advocacy work and engagement work. But I feel like that it really is something that, instead of we rushing to announce anything new, think about really who we can get as the local political leader who will own it. And because unless that's the case, it's very difficult to see how any of this would achieve the kind of transformational change that we are talking about. And the second thing that, kind of a reflection I want to share is that sometimes when we see a country, one country embracing an important and ambitious target, let's just say if we will get any of the Southeast Asia countries come out and commit to 10 gigawatts of solar, which will be fantastic. Then the lesson learned is that we often also then rush to try to do all kinds of very in-depth analysis of what that 10 gigawatt could look like. Well, actually, what we really should focus on is what that first gigawatt could look like. And that is what gives people the confidence and actually get things going. And that first gigawatt is not about a general scenario. It is actually about things in the pipeline that can happen as soon as possible. And and that's, these are just some of the reflection I want to share. The last thing I want to discuss here is how philanthropies and platform like this or other public funds can work together. I think when we talk about collaboration, it's important to think about what is the advantage and disadvantage of each of the different types of funding. The advantage of public funding, of course, is its scale, its access to government policy making, and of its very deep pool of technical knowledge and expertise. The good thing about philanthropy is we are willing to take on a lot more risks than any of you. We are willing to take on the type of risk that government or business can't really take on. And the other advantage is that we are a lot more connected with the outside players, the type of players who work to create the type of pressure outside, and we can mobilize a lot more public support and the kind of thing that a government player might not be able to do. And of course, we sometimes can move faster. And I think that if I look at at a lot of the private public partnership around, I really feel like the ones that we say are really good and effective, they all embody the one thing that it's about building on what's the advantage, bringing the advantage, highlighting the advantage of each of us. And those ones who are not so effective is normally just about coming together, but somehow reinforce each other's disadvantage. But it's a very general observation, but happy to chat more. But Tim, back to you. Thank you so much again for having me here.
Great. Thank you so much for packing a whole lot of great thoughts into a short amount of time. Fortunately, we do have some time to really reflect and explore on this. There's been a number of great comments and questions coming in on the chat. And so maybe I'll start by just teeing up a few questions for both of you to respond to. And once I get through a few of those, we can open it up to the group to see if there's any of the participants that have observations or reflections on this conversation that they'd like to share. So there's a cluster of comments and questions that came in around, kind of the monitoring and accuracy of risk assessment, and also the accountability of it, given that a lot of the approaches that have been advanced so far are really kind of voluntary efforts based on guiding principles or things like that. For how, I guess so. There's some questions about kind of how accurate and how much monitoring do we have in place to really know that the changes and the investments are unfolding in the ways that align with principles and commitments. And for the accountability side, is there really enough pressure in the system to drive that adherence to standards, or are there more, other types of approaches that may be needed that have more teeth? So we just want to see if either of you have any responses to that kind of set of conversations there.
Shall I go first, or Eileen? You have? I have an immediate. I mean, if I take that question and just look first, let me take a look at the academic perspective. If we look through the literature, there is pretty clear evidence. There's pretty clear evidence that we have a very strong positive effect of mandatory disclosure. Just having disclosure not mandatory does by far not reach the same effect. So science pretty much clearly makes the case transparency is quite important. And I'm not talking about telling people where to invest in, but just being transparent of what they do. So that has a large effect. And that's what science tells us. Actually, what the taxonomy tries to do for the European case now is to do precisely that. It's not by any means saying this is forbidden to do or to invest in, but it's sort of mandatory that large stock market funds, they have to report based on that. So that's what's going to happen. There will be transparency on that. And that's what people say will be quite important. Now the risk models that's a big thing, because the risk models are then, and now it gets, I'm going to stop very soon, but because it gets quite technical. So the risk models is what concerns people when we talk about Basel III, about own capital requirements, Pillar 1, Pillar 2, what is determining how much own capital banks need to put to hold basically for different sorts of investments. So that's why institutions are very much interested in thinking about that from the risk perspective. And that's, so that is a lot of discussion going on there, but I will strongly make the point, disclosure is something where we could need kind of a government push, because that's really helping without actually prescribing too much.
Great. Eileen?
Great. Yeah, if I may just add something. The reason why that the disclosed information is hasn't yet got the kind of trust, or sometimes not up to quality. I think there are three different kind of reasons. One is that companies simply don't know yet how to do that. And in our observation, that's actually in many cases the case, true, because it's you know, it can also be that the company hasn't really have a you know, designated people or function who actually will do that. We're funding a lot of the different sustainable business coalitions now to try to work with the different sectors and companies to try to improve that. But I do think that some of this is a learning curve, however, it is you know, the second scenario where it's not disclosed as ideally as it could be is also that companies tend to cherry pick, tend to disclose information that they think might be to their benefit, and somehow, of course, in that process, that also destroys some of the confidence. I would say that it's also sometimes because some of the external bigger environment or system is not yet so widely aligned. For example, many of the company, when they, especially power company, when they try to talk about their climate risks, they use the reference of the IEA, the International Energy Agency's sustainable development scenario. And of course, that's a scenario that is not even 2-degree scenario, and let alone 1.5. It's one of the more conservative scenarios. Of course, that's a scenario. You know, I don't want to get into the debate about the scenario. However, if you use that as the benchmark, then of course it makes a lot of these companies look a lot better than they actually are, even though they're by no means on the track to decarbonize by you know, within the next decade. So there's really some need about you know, a more consistent, what is the external benchmark reference scenario criteria metrics that we will be all using, so that disclosed information can be more comparable. And the last thing I think is just the, you know, mandatory is important. That some company simply don't want to do that, and unless by, you know, at some point that a lot of these disclosure become mandatory, it is difficult. So thank you.
Thanks, Eileen. Rob Vandenberg raised a point and question in here around urgency, and particularly given the, you know, what the targets of, you know, trying to get to net zero by 2050 or somewhere, you know, around that time frame. You know, given that there is this learning curve, and, you know, a lot of major capital investments are, you know, you get the lock-in effect of investment in infrastructure that may have durability of multiple decades ahead, and just any reflections you have on kind of triangulating against that urgency of action and the time it takes to kind of really shift and transform a whole global finance system. And if there's any kind of you know, sometimes I call them trim tabs, you know, those little places where low pressure zones where you could, you know, that you encourage people to really focus that may get larger shifts. Yeah, so just curious your thoughts on, you know, ambition and urgency, and what that might mean for strategic focus and really trying to unlock this growing interest in shifting capital flows.
Shall I go first?
Sure.
So that's not an easy question, right? That's, I can tell you a little bit on what's happening here in Germany on that, and whether that's of help for others to judge. So what I see discussions with most of them actually going on informal is that there's thinking about I mean, one thing is about making transparency fairly open, right? But that is not, that's not sufficient. It's just necessary, but not really sufficient. In parallel to that, there is need for that thinking from the end, from the consistency perspective, basically. And what I see in the discussions here, and and serious discussions, not just some NGOs, but really also with the governments and the financial market actors, is thinking about stress tests that involve something like what happens if climate neutrality need to be reached by, say, 2040. And that is, there were some informal discussions between, I mean, to inform the strategy of the government, that were between, say, steel companies and financial institutions, thinking about this scenario. Okay, what would be needed? What action would be needed? How a company, basically, say a steel company, would react if they would be required to have the CO2 neutral steel factory ready by 2035 or so. What would be their actions? And the other part of that question was, what kind of signal would the investors need in order to really believe that that would be on track, basically? So, because your question asking about the financial sector actually involves such a radical transition cannot be, solved by the financial sector alone. You really need to integrate the heavy industry, those who are on the side of the heavy emissions, into that discussions. And that's what we see going on here. So say a carbon neutral steel plant or aluminium needs this and that, and that's the signals that the financial sector kind of needs. So that gives some kind of a general impression what would be critical areas. And now I could go on for ages, which is what the critical issues are, because you then need to make assumptions. What is that scenario? Is it going to be through a carbon price? Or is there going to be sort of broadly the availability of, say, green electricity? Can you just assume that? Or is there other sort of conditions which you need to talk about? But these types of discussions, I think, are really needed. But it goes back to scenario type thinking, right? What if we would need to be climate neutral by 2040, and then starting, what would that mean for now? And I think that's really key. And that goes beyond financial sector. You need to involve the industry, which is also tricky because they are also not always neutral, not carbon neutral, but also not neutral in other ways.
Great. And I know there has been increasing focus on particularly industrial sector emissions, both by philanthropy and government, just increasing in the last few years quite a bit to think through some of these scenarios. Eileen, anything you'd add to this conversation about urgency and ambition?
Yeah, I always appreciate questions that make me feel even more stressed. So let's, but let me share a little bit, a few things that actually make me feel optimistic. We do see an explosive growth of company commitments in the last 6 months during the pandemic. I was talking with the team on science-based targets initiative, and they were talking about how they got so many applications in the last few months about company new targets. And I think that, I like to think that some of this is in response to also the growing public demand for climate. But I do think that somehow something is changing. And I want to also point out the change that we are seeing in the international climate politics. Of course, the most important thing is what's going to happen today, the U.S. However, the China commitment, it was very significant. Carbon neutral by 2060, and very quickly within 2 weeks, Japan, South Korea, the other big emitters also came out and commit to carbon neutral by 2050. So I think that these are, we're seeing these changes, and I think that they should give us hope. But if I may also add one thing, is also when we talk about urgency, there were two different kinds of response. I think that many of us, including many of the players who were very focused on some of the hard to abate sectors, the conversation is actually more about the last mile. In order to really achieve 100% carbon neutral, what we need, or sometimes negative emission carbon removal as well. And that's where, you get a lot more anxiety. However, there is probably 80% to 90% of it that we know we can achieve with existing or already commercialized technologies. And of course, on that, we still need a lot more urgency to get that done. But on that, it's less of a race to get the technology ready, but more to change the political commitment to get that really have a massive uptake of that. Thank you.
Great, thanks, Eileen. I'd like to begin bringing a few other people into the conversation here who have shared some comments. There's a series of comments that in the chat around thinking beyond climate to social dimension and others. And just want to see, Steve Waddell, would you be willing to share some of your reflections there and maybe even weave in some of the other things you've seen in the chat?
Well, thank you so much. I found it very interesting. Just reflecting, there's a very specific issue that you focused on, it seems, Ulf, the way you framed it, and that was termism, right? Short-termism. And that is a core quality that's a challenge in realizing sustainable finance. But really, it seems very, very narrow what you're speaking about. It does not address anything about the social issues or the governance issues of the ESG. For instance, the termism isn't really an issue in biodiversity. Many people are talking about inequity as an issue. I know that in the original German plan in '91, there was a whole concern about changing the infrastructure of industry, et cetera, which seems to have got passed by. But it leaves me, I guess, following in Rob's comment, a bit depressed about the narrowness of it. You've talked about one-step mitigation, which is surely the easiest, which is going to be addressed in 2022. There's all of these other steps to be addressed, which are going to be more difficult. So I'm wondering about your theory of change, I guess, is one way to frame it. It seems inadequate. It's based upon sort of agreement upon disclosure, agreement upon targets, agreement upon commitments, and then it's going to happen. We know from the Paris Accord, we know from all types of commitments that have been made that that's just generally doesn't happen.
Any reflections that prompts, Eileen, and maybe go to you first?
Sure, yeah. I think that's definitely a very good segue to take us out, look at the big picture. I think we see a window opportunity to make disclosure happen. And maybe that's the reason why somehow the two speakers today seem to get a bit overexcited about that and talk a bit about that, but by no means that we can give the impression that getting disclosure done is by itself sufficient. However, it is, we all know the challenges of translating whatever the climate community is talking about to the financial sector. On that front, we, I think it's just a matter of fact that disclosure is probably the one channel right now where that exercise of identifying and coming together to develop the same language is happening. And that's very much the concern out of climate risks. And I, personally wouldn't think that climate risk itself is narrow. It would, if like what Alf was saying, that if we actually define that both as all kinds of physical risk and transitional risk that we would need to face, then it's actually encompassing a lot more than what we have time to cover today. But I do want to say that the importance, and I think that all the social movement activities in the last few months really make us, at least make me personally, think more carefully about this issue. It is absolutely true that the environmental sector people talk less about a lot of this, and not just in terms of impacts, but I think also in terms of some of the solutions that we propose, even the the traffic congestion and the diesel ban, and those things will also have a disproportionate impact on some of the poorer and more less developed communities within cities, and how we really also have an equity lens and social justice lens on some of the solutions that we propose. I think that's there's a long way for our community to go, and so on that front, I very much appreciate your comment.
Ulf, anything you'd add?
Yes, sure. I mean, first of all, just on the short term, I mean, my point, I was trying to make the point that the issue of introducing a long-term time horizon seems to be a challenge, and I don't see a lot of that side addressed so far. But aside from that, of course, Steve, I share the impression that the social aspects of this are not, properly represented here. That's, if you want, that's more an environmental thing, the taxonomy, and in the way it's formulated here. And when you're asking about the theory of change about this, this is me focusing on the taxonomy for this case is like really by nature then focusing on transparency, and using that transparency to however far you can take this, right? That's the theory of change requires us to look at more than the financial sector. That's what I was trying to start discussing towards the end when thinking about these. If you want the potential stress testing scenarios that governments come up with. I'm by no means saying, we're on the safe side, but I guess, what we can do is try to think something consistent. And that brings you to challenges. If you think about a carbon neutral steel power plant, that if you try to consistently think that through, having investors at the table and the industry at the table, that brings some of the issues to the top, and the theory of change, I think is, I'm not a big expert on that, I have to say, but it's, these are things such as, are the scenarios consistent? Is there going to be enough? I don't. For example, hydrogen. That plays a large role when you discuss these things. Is there enough hydrogen available? Well, no. So what does that mean for other sectors? So and do we need more incentives on that side? So I think those radical in the sense of very ambitious scenarios spur a lot of thinking that carry elements of that theory of change. I'm not so sure you will have it easy to abstract from that and find that general recipe with which you can tackle most of that. And you probably know the work of related to Mariana Mazzucato, mission-based finance, and so on and so forth. That could contribute something to those questions you're addressing here. But I would fully agree, this is not addressing the full question. I'm not saying it's sufficient.
Great, thanks, Ulf. Reflecting on a few of the comments that come in, I know Raul Faro-Pellico noted that the EU sustainable finance taxonomies do have that do no significant harm, which does bring in things on biodiversity, water, land. So there's some effort. Now, it doesn't necessarily take on the social implications. I would flag for those of you who haven't had time to connect at all with the climate investment funds, along with the Center for Strategic and International Studies, has been very active over the past year in developing a just transition initiative to really create some frameworks for thinking about just transition beyond just the kind of historic focus in the multilateral development community on safeguards and other things, and really think more proactively. And I know that's also an emerging topic in the philanthropic sector as well, of how to bring in just transition considerations. And then the government arena, it's been exciting to see the EU Just Transition Fund as actually a public sector major initiative and pool of resources to really think about that. My guess is there's a long way to go in thinking deeply about the social dimensions of just transition. Like a lot of that's focused on the coal sector, but I think as Ulf's noted, with the activities for for transition of the global economy to low emissions, it goes well beyond just coal. And we're talking about lots of changes in different industries, and thinking about the impacts of those on people will be a really, I think, an area of growing attention over the next few years. I wanted to shift us a little bit and create some space. There's been a few comments and questions from Lamia Renault, and I just wanted to create space for you to bring those into the conversation.
Hi, yeah, thank you so much for that. Very interesting presentations. So what I wanted to say really is understanding what can be done, and if we put this all back in perspective, climate finance is progressing very well, and it's doing very, very well in the time that it's been on the agenda. But yet it's a small drop in the ocean of a lot of investment that is not sustainable, and it's just going against everything that climate finance is standing for. So I'm kind of thinking about whether disclosure is enough to shift the financial system, and whether the integration of climate risk, for example, in investments, taking into account in your modeling, in your costing of your investment, whether climate change will impact your company 25, 50 years down the line, or maybe just 10 years down the line, would be useful to convince companies and investors to divest from some of those investments that don't fit in those categories that were presented. And kind of reflecting also on the discussion about costs, cost is never shifted, it's always removed and downstreamed, if not to other parts of the sector, it's often done to other generations. So having a generational, kind of a generational point of view and understanding of investments and climate investment especially might be interesting to avoid some of those issues down the line, because we know that the investment into specific sectors will have impacts, if not today, in the future, and that's as important, and it kind of answers to this long-termism concept and principle that a lot of you have been speaking about today. So it's never cheaper to go for an investment into something that will give you profit and returns of investment quickly. It's always better to avoid the cost of disaster, and the pandemic that we're living in today is an example of that. Investing in protecting forest and wildlife avoids pandemics. It avoids zoonotic diseases like the COVID-19 crisis. Investing in public transportation reduces the cost of health and issues of in cities, and in destroying the wildlife is also a way to avoiding to destroy the wildlife, and our forest is a way to protect ourselves from health related issues in the future. So there's always a bigger cost to it. Just a clear example is updating your infrastructure on an oil rig is always cheaper than cleaning up a beach that is full of oil from a spill. So just kind of putting that perspective into everything that we do, whether it's in investment or in business, across all sectors is very important. And I think there's not enough done on that side, especially kind of mainstreaming the sustainable finance and the sustainability aspects of finance across the whole economic sector, and not just climate finance, is very important. There was a 2.6 trillion investment from the largest banks in 2019 that were linked to biodiversity destruction. So again, a very small drop in the ocean, very important, but there is so much more to do.
You're muted, Tim.
Oh, thanks. Sorry. Yeah, any reflections at that, Spurs? And then I'd like to tee up a question for the last few minutes to see if you could both reflect on. Okay.
Maybe I just very quickly say that, totally agree with that, I think that it also depends on how we define the word climate finance. And if we really define it the way that Makani is talking about, that where you will bring climate risks and consideration into every single business decision you want to make, then climate finance, of course, goes much bigger. But I very much agree with the two dimensions that we should really expand. One is forest and ocean, and this is also go beyond the understanding of climate, into the more planetary health and or nature. And we see initiative like science-based target for nature as well nowadays, and that's a very important that kind of new direction. And then the other way that you talk about how transport and infrastructure upgrade also help with deal with local air pollution and public health benefit. And so that's also a very important aspect, which is the co-benefit of climate actions. And I think we need to do a lot more to also understand that and be able to best harvest on that. So these are two really important ways to really expand our conversation.
Great. One of the reflections I have in listening to you both speak and to the discussion that's taken place is it makes me think about one of the things we think about in transformational change and kind of theory of diffusion of innovations is, you've got this curve, this bell curve type thing where you've got leaders and then you've got laggards and then you've got the mainstream middle you're trying to move. And if you think about the industry and commercial finance system, they're in this process of trying to shift this curve. And so part of the enabling opportunities for the leaders is about creating these opportunity space where capital can flow into the transition and the new approaches that you're trying to enable. And I see a lot of the work that the CIF and other climate funds are trying to create some of those enabling conditions. There's a new initiative in the CIF around greening the grid, thinking about how to integrate large-scale renewables into power systems, and what are the systemic changes that are needed to create space for capital to flow in and not experience risk, have some certainty. At the same time, in this conversation, we've also heard a lot about the laggards and this idea of how much, do you really need some regulation or mandatory disclosure or efforts beyond even just disclosure to prevent the continued investment in destructive technology. So it seems that at both ends we're thinking of or needing to think about how do you create that opportunity to crowd in and move the curve, and then also how do you bring up that laggards. Is that a useful construct? And as you reflect on ways that the multilateral development community can support moving that curve quickly, any last reflections that you have, particularly on the opportunity side, about how do we really create the space where large-scale capital can flow into making things happen that then create a new normal? I don't know, Alun, if you want to share any reflections first on that, and then Ulf.
Oh, so coming from an activist background, I always loved the idea of calling people laggards and naming and shaming. So that's absolutely wonderful. But however, I do think that the ultimate goal is to make this conversation mainstream, and therefore a lot of it, and as I shared that. Even just in our work, a lot of the current challenges is indeed a lack of consistency, lack of knowledge, and lack of the ability to have a conversation across different disciplines. So I do think there's a lot of work for everybody here to do to bridge that, and maybe, but in the meanwhile, we can still use those labels and keep the pressure up as we achieve our goals.
Thanks, Alun. Ulf, any last thoughts that you have on reflecting back on the conversation so far?
Yes, maybe they're not so nice, but yes, I have immediate reaction. So you were talking about this diffusion curve and things. My picture of this is something that the industry is always, that's one of the issues that's driving a large part of the industry, is trying to have this forward-looking perspective. And yes, there probably are, if you take one heavy industry sector, there probably are leaders and laggards. But I'm a bit hesitant to sort of think a lot about how can we get the laggards going. To be quite straight, I think another perspective would be, if there is the leaders and the laggards, a substantial pressure from the climate policy, from the emission reduction side, will make it easier to distinguish leaders from laggards. And then what I would expect is that the leaders get more capital, can attract more capital, and the laggards can attract less capital, and maybe drive out of get out of the market. I'm afraid it's not a good idea to make sure that all the laggards can perhaps try to catch up a little bit. Maybe that's not nice, but I think the leaders need to be supported and not so much talk about the laggards in that sense. Of course, I should say that, then there's all the social concerns. I don't want to be that cold-hearted economist, but talk about the people when it's coming, when you're on the losing side. But when we talk about commercial companies, let's talk environment.
I think it's great that towards the end of it, we also have a bit of a division of labor between us. So that's great.
Nice. Well, I just want to thank you both, Ailun and Ulf, for a really wonderful conversation. I think this is really a bright spot where there has been some really rapid change, and hopefully we can translate that into a lot of investment in climate action over the next decades, which we know is going to be needed in order to enable this transition to happen. And so really excited to connect some of this, what's going on in the commercial sector and the private sector, with some of the work that's playing out in more public spheres. And I think thinking about the interplay between those two will be really key to our future success. So thank you again. With that, I'd like to turn it over briefly to Regan Smurthwaite from the CIF TCLP to just really briefly let you all know about some upcoming webinars and activities that you all may be interested in. Regan?
Thanks, Tim. Hi, everyone. Thank you so much for joining us for this TCLP webinar on sustainable finance. And thank you also to our speakers for a really enjoyable presentation and discussion. I wanted to alert all of you to upcoming webinars that the TCLP is holding. Our next broad public webinar is on December 3rd on making bold choices for transformational change, talking about taking risks and planning for the unknown. We also have several webinars for our interest groups. Now, our interest groups have a series of webinars, and the upcoming webinars include a webinar for our resilience interest group on data, technology, and innovation to drive urban resilience through regenerative infrastructure. And you may have seen a comment from Mr. Alfaro Pellico earlier in the discussion. He's going to be giving a presentation, and if you're interested in continuing this discussion of taxonomy regulation, that will be touched on during the discussion. We also have additional interest groups on landscapes, concepts, methods, and metrics of transformational change, and clean energy. And I invite you to let me know if you are not on our distribution list for either the Transformational Change Learning Partnership or any of these interest groups, to please contact me so we can get you information. And with that, just thank you all again. And Tim, if you have any closing words.
Just to thank you all for joining today, and really excited to continuing the discussions in the upcoming webinars. Thanks so much. And thanks again, Ailun and Ulf.
Thank you. Bye-bye.
Thanks a lot.
Thank you.
Pleasure.